Well, hello everyone. We're going to wait. We got another waiting for about another 200 people or so. We're going to wait till 11:03 Pacific and then get started. Thank you. Well, all right, we're going to go ahead and get started now. Appreciate everybody for joining our Taper Tantrum 2.0 webinar, comparing 2013 to 2022 and what lenders can do. Um, just high level on reasoning for the webinar. For those of you that have been hedging over the past 9 years since 2013, there are a lot of similarities, a lot of good news as far as differences, and one of the big the big differences that we're going to talk a lot about is the health of the aggregator market right now, and just pricing, and how that is stuck to the market versus 2013. But if we look at the period of Q1 2022, really it is the top three most volatile times in over a decade. So you have 2013, of course, 2020, and now 2022. When we, just speaking to kind of where I think where the market's heads at, correctly so, on this market turn versus 2013 and versus 2020. If we just look at attendance on this webinar, we've got about 600 people attending, which is that's a very large webinar, and we thank you for for you guys for joining, and we think it's going to be valuable use of your time. But if we look at 2020, we were regularly breaking 1,000 participants on industry webinars. So you can see that there's definitely not quite the urgency that we had a few years ago, and as we'll go through some of these slides, you'll see why. So as far as the presenters, my name is Phil Rosori. I run hedging and technology for MCT. We're also going to have Andrew Rhodes, who is our head trader, and he's going to give us some trade desk recommendations for just for the clients on the line. while the whole webinar won't be review, obviously the trade desk recommendations, you guys have gotten those in a lot of previous webinars over the past 6 weeks, and market flashes. So some of this will be review for you guys. And then we've got Justin Grant, our Director of Investor Services, and he will go over kind of what we're seeing on the buy side. And again, like I said, a lot of good news there, and a lot of changes versus 2013. So we got a lot to cover. We're going to get right into it. On the agenda here, I'm going to be comparing, some of the market events of 2013 versus what we had in Q1 of this year. We'll go over some coupon liquidity issues. These issues are probably the biggest concern we've got. A lot of you guys, probably all of you guys that are currently hedging, are well aware of some of the new liquidity issues we have in the higher coupons for originating product, especially higher LLPA product like a cash out or a non-owner, or dare I say a second home. These will basically price you out right now, where you have to charge substantial points to actually originate a mortgage based on kind of the coupon curve that we've got. So that's the biggest issue. Andrew's going to be going over that. Andrew will also be going over the trade desk recommendations that we've got, because there have been a lot of changes. Again, review for the clients on the line, but we really haven't seen these kind of roll costs, although the yield curve is not super steep. There is now a substantial differential between where Fed funds sit and where the coupon, market coupons of 4.5 and 5 pay, and that creates a larger time value of money and therefore a larger roll cost. So that materializes in your hedge as greater burn time and the need for charging additionally for extensions, for longer term locks. So we'll go into all that. Justin will talk about the liquidity situation in the aggregator market. As I said on the outset, liquidity in the aggregator space is very good right now compared to 2013. 2013, we had a situation where there was only a couple buyers, in one depository that, to their credit, carried us through the period of 2012 into 2013. But there was definitely limited competition. And, for the health of the market, 2013 actually created this proliferation because the MSR asset became in vogue again as rates rose. And, we had a proliferation of aggregators, and that, has helped create the market that we've got today, which is much more, much more competitive. And so Justin will talk about some of those performance metrics that we've seen, and then we'll summarize some key kind of recommendations and some potential concerns that we've got on the forecast. So just looking at the taper tantrum of 2013 versus today, for those of you guys that were in the market, you can remember it was the April 30th, May 1st Fed meeting when Bernanke, for all of his strengths, I think history has already looked back on this meeting as not being telegraphed well at all to the industry when they were going to start basically tapering their purchases. The balance sheet at this time had moved from 1 trillion to 3 trillion. And they thought it was time to begin to taper. We were in the middle of QE2 at that point, and the market, did have a tantrum. There was a substantial drop in MBS pricing, rise in rates, and then that was further. There was another kind of communication problem in the June 20th meeting. Where we had, over the next few days, we lost about 400 basis points in market value, and and rates rose about 1% rate over that next week. And so all in all, the magnitude of the drop was about 9 points, a little over 9 points. And if we look to the right here on what we've experienced, and just talking about the similarities, and again, really the main reason for the call here today is you can see we're within striking distance at 820 basis points versus what we did in May and June of 2013. And a little bit more volatility in May and June, and we'll talk about that. That's been a key difference. Again, the striking similarities are, for those, it's hard to remember this, but we were at the exact same coupon when we were on May 1st. May 1st, we had a market coupon of the threes. And if we look at kind of comparing that to January, beginning of January this year, we were at a 3 market coupon as well. And we basically transitioned up 150 basis points in both cases. So a lot of similarities there. I think the key difference when we talk about those first 4 bullet points, we'll get to the 5th in a second here. But when we talk about those first 4 bullet points, the big difference is bullet point number 1. So that happened over a period of 2 months in 2013. We had 2. For those of you that remember, we had Memorial Day, we had 4th of July during those 2 periods of deterioration. So we really only had 38 trading days, and it was a huge move. So fast forward to the right here and look at 2022. For all the faults of the Fed, and those are very well known in the market here, look, this has been a relatively orderly decline. And again, I think that's why, we all know that's why the market's not freaking out right now, right? That in general, that this has been a period of basically twice as long for the same market move with a little bit less volatility. We always say that, no matter how strong your conviction is on where you think the market's going, you never know. And for those of you that were for those of you that were in the market in 2013, and take yourself back to June of 2013, specifically after June 20th of 2013, you were absolutely certain that rates were going nowhere but up. You were absolutely certain of that. There's no question. If you said anything differently, you would have been completely laughed out of the office. 9 years later, of course, that didn't materialize until today. And of course, the key difference that's on everybody's mind here is the 5th bullet point here of inflation, and that's pretty stark, right? So I think that no matter where obviously there's geopolitical risks all around. We don't have to talk about those, but there is a key difference here of current exhibited inflation of 2022 versus 2013. And again, obviously we as we always do, we're not going to make a market call here. But with that said, you could, there's a serious case to be made for, a substantial and continued raise in rates to, as the Fed has telegraphed here, to eventually break inflation. So just going over, I'm just going to go through some quick graphs here. Again, what this does is this shows in this red here. I know it's kind of hard to see, but it shows the volatility that we had during of the 3 coupon of back then it was the Fannie 3, now it's the UM33. And you can see that the big spikes here, exactly what we talked about, are in 2013 and in 2020, and here in 2022 Q1 it pops up, but it is nothing to the extent that we've seen in, in 2013 or 2020. I do want to, the talk about the similarities here of today versus, and again, what we've seen in the market here. This is the UM33, basically year to date, and you can see we lost 200 basis points in kind of this first run down, and then over the past 30 trading days, we've lost basically another, let's call it 5.5 points. And if we fast forward onto what happened in May and June of 2013, you saw that same that same move. You saw this initial, more gradual move down, and then a large drop after the second Fed meeting. And that's when there were some, in the aggregator, in the loan buying side, the buyer community, things started to break after that second tranche there. That's going to be in late June of 2013, and so we'll adjust and we'll come back and compare some of that in when he looks at investor pricing. So what we're going to do for the webinar here is we're going to talk about, what's happened in the investor community, what's happened with, in the lender community, specifically with respect to the loan sale experience and with respect to volume. And when we look at volume, we basically have the broad industry market index to look at, which is the MBA index. And then we're going to look also at the MCT lock volume index, and there's a couple key differences that I want to talk about. So MCT lenders in general are going to be on average versus the MBA index, which again is the broad index. As we all know, that's 75% about of mortgage applications, in the country. In general, on a weighted average basis, MCT clients are going to be more independent lenders, and they're going to be more retail. And the reason I want to point to that, for those of you on the line that are retail, there is a big difference in the numbers that we're seeing. So last week, we saw year over year apps were down 35%. If we look at MCT's numbers here, and those are in the yellow line, what we've done here is we've benchmarked an index of a trailing 10-day trading day moving average to a year ago exactly. And when we look at that, we're only down about 18%. So about half. We're down about half as much as MBA. And when we look at purchases, and that's the key difference here, purchases last week were down 6%, but the MCT index purchases are up 16% year over year. And so what's the difference there? The difference is very simple. That is your household name lender, consumer direct getting crushed in a purchase market year over year. That's the bottom line. And if you look at where current refi versus purchase sits, in the index right now, the overall MBA index, last week it was 37%. For the MCT average, it's 16%. So you can definitely see that there's still for the broader index, there's a larger kind of distance to fall there. And look, I'm a huge fan of technology, but at the end of the day, in this purchase market, again, we are not seeing consumer direct hang with retail in a purchase market. That's just the bottom line. Just some stuff to look at. You can see the rate terms on the red line there. Those are down 86% year over year. That is completely expected. What I want to point you guys to is the green line. So just 3 weeks ago, the green line was basically at a par index. That was exact, and the green line is cash outs. So just 3 weeks ago, cash outs were basically at the same level in the MCT client base that they were a year ago. And you can see that in a period of 3 weeks, they basically fell 50%. And there's a key point there. In those 3 weeks, we went up 80 basis points in mortgage rate. That's a big move. There's also an issue here that Andrew's going to talk about, and that is market premium, basically premium pricing on coupons. When you get into the world of LLPA, higher LLPA originations, we do, and that's the one, kind of concern that we have right now on the desk of, as you know, and that all of you have, as we originate new coupons, or as we originate this production in new coupons, for that production that needs that premium, right, to cover those LLPAs, it's getting harder and harder with these higher coupons because there's so much par compression that Andrew's going to talk about. It's hard to originate that product, and so it's been a little bit of a double whammy on the cash outs. Again, in the MCT volume indice, cash outs and refis are in rate terms are only just over 15% of total production, so it's not a large concern. But it is true that we've definitely seen cash outs capitulate in the last 3 weeks, and that's, again, rates, but also, frankly, more importantly, a function of where the market's pricing these premium coupons. And so we're gonna transition to Andrew, and he's going to take us through some of those liquidity issues and also some key recommendations that we've got from the desk.
Awesome. Yeah, thanks for that, Phil. So, just to cover a couple slides here, going over some recommendations, stuff that I talk to our traders about all the time. Just trying to stay ahead of, current production, and then also flowing production in terms of, funded production in the open pipelines. So just on this first slide, touching on the coupon liquidity issues, the graph off to the right is showing the weighted average locked note rate in our pipeline. So at the beginning of the year, we're just a little bit over 3.25 for our weighted average lock rate. And looking at it, I think currently we're a little bit over, like right around 5 1/8. So huge move in kind of the locked note rates coming in on the front end. And kind of the issues that's been causing with the investors has kind of been two-sided. It's been having the flexibility to provide pricing on the lower note rates to make sure that the loan origination flowing through for hedge pipelines can still be sold, and then also pricing out on the higher end, the higher note rates for that new incoming production. So I guess the issue that we're having there is just the compression on the higher premium coupons, like Phil was talking about, because we're not really seeing a lot of production start to flow through and on the higher end. So that really leads to illiquidity on those higher coupons. I think once we start getting more production flowing through on the higher note rates, we'll definitely see some better liquidity on those higher coupons. I was actually just taking a look at this right now, and on the 5% coupon, we're seeing about an 8-tick bid-ask spread. I know if you're getting those bids out in competition, you're able to get probably a little bit better than that on the screens, but still, it's a pretty big bid-ask spread, and I'll kind of touch on that a little bit later on as well. So just talking about kind of the liquidity, I reached out to a couple aggregators this morning, and even though they're only going, or I guess their note rates are starting at a certain level on the rate sheets, they're still providing liquidity on the bulk side for the lower note rates. So even if you have 3.5, 3 5/8 note rate, or even lower in the open pipeline, those bulk investors are still out there, and they're still buying those loans down that low. we're still seeing, investors out there buying down in that 2 and 2.5 coupon, which is crazy considering, we're at, I think 2 right now is at an 88 handle, and 2.5s are low 90s. So it's it's an interesting dynamic because we're seeing more liquidity on the coupons that are trading at 94 than we're seeing on the coupons that are trading 104, which never happens, right? We've just never really seen that kind of liquidity issue when trading the TBAs, and that all flows through to what Phil was talking about earlier with the premium pricing on those higher note rates and the higher coupons. But yeah, Phil, let's go to the next slide. So just some practical recommendations here. With the volatility that we're seeing, we want to make sure that we're trading as much as possible to match the loans that are incoming. I know over the last couple of years, it's been pretty simple to kind of just bring production in and wait until the market's closer to the end of the day and put a trade on to cover your hedge. But I think with the volatility that we're seeing, I mean, we've seen today it's moved around probably close to half a point on the fours, just up and down today. So if we're not trading to that production, then you're essentially eroding some of your margin that we're trying to lock in. So that's where it makes sense to do trades more frequently. And I think one of the benefits of the new kind of the hybrid AOT program that a lot of these investors are offering is the combination of smaller trades to make a bigger AOT, right? So back with the legacy AOT models, I'm sure you guys are all aware, you had to have a bigger block, a $5 million block, and then you could whittle that down to do $1 million, $2 million AOTs. But now you could have four $500,000 trades and do a $2 million AOT. So there's just a lot more flexibility in the AOT program nowadays, and I think that's being able to trade more frequently allows you to manage that margin that you guys are looking to lock in, and then on the flip side of that, when you're executing on your funded production, you're able to take advantage of the AOT functionality as well, even with the smaller trades. So a lot of the benefits of the AOTs are, I think the biggest benefit, I don't think a lot of people really catch on to, is the cash flow management piece of it. So essentially, your outstanding exposure on those trades is going to roll up into the loans that are getting purchased. So if you have, a trade that's, 5 points in the money and it's not going to settle here until May, you're going to have to wait, 30 days to get your money on that security if you just pair out of it. If you go ahead and you assign it, then that 5 points in the profitability trade or the trade profitability would roll up into the loans that are getting purchased. So it really does create a lot more cash flow efficiencies by utilizing the AOT program on top of the bid-ask spread savings, which is on the higher coupons. It's a little bit wider. I mean, even with the volatility right now, looking at the threes, Fannie threes were about a tick plus, so call that close to 5 basis points that you're saving right there just by not having to call a dealer or get out of a TBA position with the dealer. So there's a lot of economics, and like I said, I think the cash flow efficiency is the biggest savings that a lot of people takes them a minute to kind of to catch on to. And then in terms of that graph that I was showing you a minute ago with the note rates kind of edging up higher and higher, we're having to, if you're not assigning that production to your open pipeline, if you're not assigning those trades, then you're having to pair out of them and roll them closer to notification. But you should be rolling up in coupon. You should be hedging it more appropriately. I think right now we're looking at the 4 5/8 up to the 5% going into the 4 coupon, 5 1/8 up to 5 5/8 going into the 4.5, and then 5 3/4 up to 6 1/8 is going into the 5. But like I said, that 5 coupon is definitely trading a little bit wider. But that's one of the advantages of the AOT, is that you could mitigate that bid-ask spread of 8 ticks by assigning that production. So if you're bringing in that production, it's tough to trade at those wide bid-ask, but there's going to be more liquidity coming into the market. Those spreads are going to come in, and then also you have the AOT advantage to assign that production to offset that wide bid-ask spread. So talking about just continuing to do the roll swaps and the coupons, we want to make sure that we're matching up with our production as it's coming in. So those higher note rates, we can't, it's the offset of, or using the new production coming in to offset loan sales, or the loan sales to offset the new production coming in. It's a harder thing to do nowadays, just because you're taking on a lot more basis risk by cross hedging those coupons, and it should be more coupon based, which is why I've always talked to the traders about rolling up in that coupon. So I know there's a lot of different a lot of bullet points on this one. I'm not going to go over all of them. We're going to distribute this slide deck out to all the registrants for them to kind of go out and look over. I think one of the things, one of the biggest points that I wanted to touch on with this slide is just going over lock extensions, right? So I think we'll get into this on the next slide, but the rolls have definitely widened out on the more trading coupons right now. So the 4s and the 4.5s. So we're seeing, closer to, I think it's a 16 tick roll for 1 month. So that really does blow out the hedge costs. So we want to make sure that we're pricing that appropriately for any extensions. I think there's also a point in time where extensions, even if you are pricing it appropriately, there needs to be a cap in the terms of what you're allowing your originators to do. Maybe allow them two extensions up to 30 days maybe, or maybe there's some market component that you can put on it saying, hey, we'll allow you to do 1 extension, but if your second extension is outside of a 5-point difference from the original lock price, there's going to be, we're going to have to talk about not extending that lock again after this point in time. So I think there needs to be some consideration to market movement when it comes to doing the extensions. I don't think you could just do a cold, no extensions allowed. I don't think you're going to be a favorite of anybody if you do something like that. But I do think there is a way to get forward guidance on it. And who knows when we're going to run into this situation again, but it has been a situation where we have moved so far so fast that a lot of people are starting to get stuck with note rates that are starting to fall off of investor pricing. So just keep an eye on that for any extensions that come across the desk, and make sure you're looking at the current price in the March market compared to where the lock price was at, and how many times have we extended this lock, and does it make sense for us to continue to do so. So I think those are, I think that's probably a big piece of the conversations that we're having nowadays with clients that are having these, note rates in the 3s in the open pipeline, just kind of managing that kind of risk. And then I think, like I was talking about earlier, a lot of these bulk investors are still offering liquidity on the lower note rates, even if they're not pricing out to it on the rate sheets. So I've seen some investors price down to a 2 coupon. I've seen some investors out there say that they're going to be buying a 2.5 coupon out into July. I still think that you need to be proactive on a lot of those lower note rates, and kind of working with the originator and determining if it makes sense to keep that loan in the open. So I think as we continue to see, with the pressure that we have right now on rates, I'm not sure exactly how far we're going to go, but definitely want to make sure that you're looking at all of that lower note rate production, and talking to the originators about that production. Phil, if you want to go to the last one here. So as I was kind of talking about, and these are really more of the current production coupons that we should be looking at. I did a 2-month roll earlier today, and I got 62 ticks. So it was or sorry, not 62. Uh, it was 32. Sorry, it was a point. So it was 16 ticks for the for the 1 month, and then another 16 for the second month. So but it does show to that increased roll costs that we're incurring. So I know a lot of investors kind of have their static extension at like 2 or 2.5 basis points. I think that covers it, but it's not the cash center that you used to have. With the hedge that we used to have, where it's close to a basis point a day. If you were charging what the investor was charging, it really was kind of a profit center. Now it's becoming less of that as it gets closer to the true cost of what it is for the extension. And then this also goes for the bid offer spreads. We've seen those widen out. So on top of the rolls widening out, on the illiquid coupons, the higher end, we're seeing wider bid ask. So that's important to take into consideration as well when you're pricing out to the front end, as well as when you're selling on the back end to make sure that you're utilizing that AOT ability, and just taking that, and instead of looking at it as a negative and seeing that as a positive, because you're able to kind of pick that up. And then this last point here was just matching to the expiration. This will kind of reduce some of those extension costs, or some of those roll costs. So if you're pricing out, if your loans are locked on a 45-day, and that it usually takes an additional 5 to 10 days for loans to close and for you guys to sell them off, then you guys should be looking at a 50-day, 55-day window in terms of where you want to set that hedge out to. One of the beautiful things about the AOT side is, like I said, the cash flow management. So even if you are setting a hedge further out, you're able to you could assign that and bring that cash forward in the transaction. So it's allowing you to kind of get that cash flow earlier, not have to worry about rolling those positions out further and incurring that additional cost. And then one thing that's not on these slides that I know I wanted to touch on was just the higher coupon pricing. And right now, I mean, we're starting to see more pickup in the jumbo fives. I think we're seeing closer to about a point between the 4.5s and the 5s, and that's kind of recent. Truthfully, I would say 2 weeks ago nobody really wanted the 5s, and now it's starting to become more popular, and we're starting to get more liquidity in those higher coupons. So I think once we get more origination flowing through on those higher coupons, we'll definitely be able to start getting those higher note rates priced out and getting some of that premium to start flowing through on the front end pricing. So you're able to lock loans above par. But kind of I guess that's it from the trade desk side. So I wanted to hand it over to Justin to talk about the investor side of it.
Yeah, thanks, Andrew. Good recommendations for everybody out there. I know our clients have been getting a lot of those, like Phil mentioned in the webinars and news flashes, but some really useful stuff. Got to the good news that Phil was talking about or alluding to earlier, in his opening remarks there. Wanted to give everybody really just a snapshot of investor pricing, both from the agency standpoint and also aggregators, just to show, in this case, how well pricing has tracked the underlying securities, the TBAs. And for MCT clients, a lot of you guys out there, I'm assuming too, that are hedgers, the hedge vehicle, right? And that's why this is exactly why we hedge with TBAs. You're hedging your loans with the instruments that's deriving the price of those loans. So what we're showing here, just a couple of note rate examples, really in the threes, largely where, production, 90, 60 days ago was being originated, and really we've had 8-point decline since the start of the year, as Phil was talking about. And if you look here, first example, we're just showing a 3% note rate, which was best exited a 2% coupon. The orange line is just a graph of that 2% security. So you can see back on January 10th, we were just shy of 98 on the security. And then if you go actually about 2 weeks earlier from today, about a 91.5, and we stopped it off there just because that 3% note rate was, I think that's when the agencies, roughly around when the agencies cut that off, at least from the cash window pricing. But the blue line there is just the daily graph or the weekly graph of that 3% base price per the agencies. So you can see there, how the pricing, at least from the agencies, is moving in lockstep with the underlying security that everybody is slotting those note rates into. And so, another way to look at that is by just looking at that pricing differential. So you hear the term, note rate spread or note rate adjuster. BAM marketplace clients of ours, we call it the security spread, right? It's just that difference in price between the underlying security. And you can see, at the start of the year for a 3% note rate, you're, about 182 basis points, pay up over that 2% coupon. And again, over this, decline over, now going into, month 4 here, really we've only lost about 10 basis points in value. And again, this is the 2 coupon, right? This is the TVA that's taken the brunt of, the sell-off. And actually, if we were to graph and we still had agency pricing, the 2s are now trading with an 88 handle, even 87 actually, if you go out to June and July. So, you're talking a 10, 11 point sell-off. And this is extremely, good performance here, just how, stable the pricing has been relative to the underlying security over this sell-off. Phil, if you want to go to the next one, we'll just kind of illustrate same thing. The 3 3/8 note rate, right? Same story. 7-point sell-off up until about a week ago. These last couple of note rates I'll show you here actually gained a little value, about 113 basis points to start, and 116 basis point, over the underlying, in this case, 2.5% coupon that 3 3/8 is being slotted into. So extremely stable price performance from the agency's cash window. And it's why, if you're an MCT client, you hear us, always recommend getting approved with at least one of the agencies, because in just times of distress, and volatility, you're going to tend to have much more stable, price performance relative to that underlying security. So if you want to go to that 3 3/4 as well, we'll just show the 3 3/4 note rate against the 3% coupon. Again, same story, almost 7-point, about a 7-point sell-off. You can see these have moved in lockstep, and we've actually picked up a few basis points, about 43, 44 basis points. That agency cash window price is getting paid up over that 3% coupon. And as of about a week ago, we're at 46 basis points. So, when you put this puts that large sell-off into perspective. If you just think about all the red everybody's seen on the screens, and I know where it says the volatility has been a little more muted compared to 2013 and even 2020, but extremely good price performance, which bodes well for for everybody. I know a lot of you out there have the ability to sell directly to the agencies. But the aggregators too, a big difference from 2013, Phil was talking about. The aggregators have done a great job as well of keeping in line here with the price movement, with the price action. So again, we're if you look at these lines, we're just plotting out an agency retained price here in blue, a co-issue price in red, And then what we're doing for the aggregators is we've taken the average of kind of the top 15 or 20 aggregators that we see in the market here, and you'll see pretty much all three executions moving in lockstep. And Phil mentioned 2013 was a bit different. That was really the genesis of servicing asset coming in vogue, and the start of the market as we know it today, right? With so many buyers, so many options, and outlets. It wasn't the case in 2013, right? We had, a couple banks, maybe one or two independent mortgage companies that were, active and correspondent. So our MCT, our average client, might have been selling to 4 or 5 different investors. Now that number is broaching 20 investors on average, and we have clients literally selling to 30 plus different investors. So that certainly helps. It's a healthy competitive market, which helps to keep pricing in line from the aggregator standpoint. So big key difference. And I think you could maybe even argue with the kind of the second taper here we're going through. We're already starting to see as well some more interest from new buyers coming in the market, if you can believe it. But I think ultimately that bodes well for maintaining a healthy competitive market here going forward, which translates into pricing tracking very well. That being said, we're still dealing with some of the liquidity issues that Andrew talked about with the higher note rates. And really this is something we send to our BAM marketplace participants. And I know for the MCT clients on board, you guys know, many of you participating in our BAM marketplace. For those who aren't MCT clients, don't know, this is really the first open, transparent loan exchange that we've created that really lets you as an originator, a seller, gives you transparency into all the other executions out there, even if you're not approved. And you can even transact with many of these folks. And so we're trying to provide that transparency and that visibility really into other executions out there, right? So, worst case, you can make sure that you've got the right set of executions. Pricing you're getting from your existing investor set is strong and competitive. But we'd argue in times of distress, like elevated volatility, like we've been seeing with the sell-off, transparency is certainly key. You obviously have a much higher probability with things just shifting around. Some of your investors, portion of your investor set, right, may have to price in a little more margin for the volatility, or to this point, they may not have the execution at those higher note rates. And so this is just kind of a graph of what our marketplace sellers are seeing for loans they're committing to our participating buyers. And you can see here on average, it's about 16 basis points. But the key here is that the higher note rates, right, with that, with the liquidity on the decline, the higher you go in rate, there's also more opportunity, for a price pickup. And so it's just good to see that. I mean, if you look for conventional loans, you can see, rates 4.5 and greater, and even up into the 5s. You're double, triple the average of what you're seeing. And same thing on government production, where you're almost double the average. So that's extremely key. Even as pricing has, again, on average moved in lockstep, there's still going to be opportunity. You want to make sure you're making sure that you're optimizing your investor set and not missing out on any other potential opportunities. Again, we're bringing that transparency with BAM Marketplace so that you can see what you might be missing if there's somebody else out there, buying that fits your loan profile of the loans you're originating. So you want to go to the next one? Yeah, perfect. And just getting back to, assignment of trade, really in these types of markets, and we saw this, a couple years ago with COVID, it's really, the cash flow efficiencies are really great, but, in this type of a market where margins are a little bit thinner, it's tough, volumes are down. It's no longer a nice to have. You need to have the execution. And an MCT, if you're an MCT client, you know that we routinely push Aots, the bid Aots on most of our webinars. And there's a reason. Again, getting back to those higher coupons, you're seeing elevated bid-ask spreads. Even in normal markets for government loans, you might see a 2-tick bid-ask spread. Plus if the dealer might take a small spread on when you go to pair out of the trade, you're easily 6 to 10 basis points in savings in a normal market for government loans when you can assign. Fast forward to today where, we're lucky if we're kind of in a 3-4 tick bid-ask spread, especially on some of those premium coupons. So now you're talking, an eighth and above in savings. That's legitimate dollars that you're leaving on the table. And, MCT with our best execution tools, you guys know it's as simple as a click of a button to take advantage. So it really is, free money. And on top of that, a market like this, Andrew mentioned that you're able to wrap the gain from the trades into the price of your loan. So I know some of you are, starting to experience margin from warehouse lines, right? Which we haven't had a situation like that in a long time. So AOT is absolutely can be a complete game changer. And so we've got the tools for our BAM marketplace buyers. They have the ability to offer AOT. We're 100% all in supporting the execution with our buyers. If you're a buyer that doesn't have it and needs the support, we can certainly help you out. But again, it's absolutely critical in a market like this, just from an economic standpoint, but also from a cash flow standpoint as well. So we've got that completely automated for all the parties to make it as simple as possible. And you can see right there the numbers at the bottom of the slide. I mean, if you talk to most of your investors out there, they'll say MCT is by far doing the most assignment volume out there. And so Q1 we've had just about $5.5 billion in assignments from our client base, with an average of 8 bips, and that bid offer spread over that time period, which is translates to about a $24,000 plus average savings per client. So it's real money on top of the cash flow efficiencies as well. So if you're not taking advantage of it, you absolutely need to be in this market. I think Phil.
Yeah, we'll
transition it back to you for.
No, thanks to Justin and Andrew for giving a lot of valuable info there. Specifically to AOTs, make a couple comments on Andrew's some of Andrew's recommendations as well, but specific to AOTs, what Justin was talking about, I think that look, a lot of people think of it as paradoxical because you think of AOTs and you think of the benefit of AOTs in a market rally where, and again, take us back to those scary moments of the end of March of 2020, when we had these margin calls that truly presented an existential cash risk to independent mortgage companies, independent mortgage lenders. And so AOTs were essential back then. Fast forward to today, so we have the exact opposite happening, right? Where you're losing money on your loans, your trades are worth a lot. You can make the argument, as Justin was saying, that, and Andrew was saying, that AOTs are more valuable in a market decline than they are in a market rally. And if you just look at today, if you have loans that are getting purchased today, or you're selling loans that are getting purchased today, and the cash window or the aggregator is, performing on purchases, you're going to get them purchased in the third week of the month, right? So that cash flow is from the loans, or the lack thereof on the loan side, is coming through on the third week of April. Yet, you're going to be waiting till the second, third, or fourth week, depending upon your Class A, Class C, Class A, Class B, or Class C security for the corresponding settlement. So there's a huge lag that occurs as in certain, especially in certain times of the month, that is fast forwarded. We can fast forward that cash that currently exists in those settlements into the loan price when you assign the trade, because of course the trade price becomes the loan basis price, and that gain is basically assimilated into the loan price that's purchased. So from a cash standpoint, and look, we're not there yet in this market move, but there's no question that loans are being sold for south of 90, and have been, and so those are large cash. Those are large cash hits. Those also create, as the warehouse line, as Justin was saying, looks at mark to markets. Those also create margin calls on the warehouse side. So that first bullet point, we will continue to push the industry because we think it's our responsibility to do so, as of moving AOT from a nice to have to an essential component of doing business in correspondent. So definitely just wanted to add on to what Justin was saying there in on the AOT side. Just on some closing remarks before we get to some bullet points, just some of the stuff that Andrew was talking about. He sees it every day, so he talked about it really quickly. When he talked about a 32 tick, that's a 1 point cost when he rolled a security, and I'm going to guess if he's rolling that security that was already a liquid security, so that's probably a 4 or a 4.5, and he's getting charged a point when he rolls that 2 months. So that's a 0.5 point per month cost that he's getting charged just in the time value of money, right? We're rolling it, so if we're going offer to bid, we're only incurring 1 bid offer spread in that, basically in that 2-month roll. And so it's very important to realize, for those of you that have been hedging for the last 10 or 15 years, that these new rolls do change the world with respect to charging for extensions, and especially once you get past, if you're extending like 60-day locks, you're guaranteeing yourself that you are going to incur another bid offer spread charge, right? And if it's a bid offer spread charge on a higher coupon, that can be very costly. And so, most of you are following the investors' best effort lock extensions, which frankly are still in the 2 basis point range. Some are 2.5 basis points. So that covers it. But it's, again, for those of you that have been hedging for a decade and a half, you're used to that cost being a profit center, right? A profit center such that in some markets the roll's been 3 or 4 30 seconds, right? Where that's been an 1/8 of a tick, where you can give away that extension, right? That's no longer the case. There is a legitimate, a very legitimate cost to rolling that trade and to extending that lock. And Andrew talked a little bit about lock extensions and how we should potentially put policies in. And I know a lot of you guys cringed, who have to deal with the origination side. A lot of you cringed when he said that. But remember that a lot of the policies do have a 2 extension rule in them, to begin with. It's just that because extensions have been so cheap when you're hedging over the years, a lot of that has, and of course we've rallied so much, right, that we wanted to do everything we could to close the loan. And if it was giving free extensions forever, that's what sometimes we had to do. Now we're in a different market, and we see extensions right now that are, where we've got 3.25 note rates that have been extended since 30-year fixed note rates that have been extended since the beginning of the year. The hedge is on, so the market movement is covered there. But now Andrew talked about the cash window and some of the limitations on the cash window ranges of rates, and investor ranges of rates. If you continue to extend that 3.25 30-year fixed rate into perpetuity, you're going to run into problems where the liquidity of that is just not going to be there anymore. And so again, that's sticking to those policies. You can talk, if you're an MCT client or a lock desk client, definitely contact your lock desk representative or your MCT trader. But the world definitely has changed there. It's possible, as if mortgage rates are continue to stay the same while the Fed funds rises, you could see basically a tightening of that roll cost. But right now the roll cost is back in the back in the days of 2003, 2004, of very steep yield curves, where it was half a point a month on market coupons. So that's important to understand. So when we talk about the potential downside risks here, bullet point 1 and bullet point 3 here are really one and the same. We are, Andrew talked about this in detail. We are concerned about these new coupons. Those definitely, they will trade more competitively. The bid offer spread will go down. We will be able to trade a 5 coupon effectively here shortly. There's no question about that. The question would taking in the fourth bullet point here, the concern is that if the Fed is truly behind, we saw Dudley's article yesterday in Bloomberg, make that case, and he's been right. That if the Fed was too far behind, and we did continue to see upward transitions, basically this transcendence of higher and higher coupon, you're going to continue to have basically an origination concern on those higher LLPA production, because you're at that, especially for purchases in the non-owner and the second home space, you're going to have to come to the borrower is going to have to come to closing with points, and in our country they're not used to doing that. So that's definitely a one of the potential downside concerns. But look, just to summarize, and I'm sorry we're over time here. Look, the market decline's been severe, far more orderly than 2013. And really the key difference has been the aggregator strength, the agency strength, and then the lower coupon liquidity. I think that this is definitely a much healthier market, than we had in 2013. And again, bullet points 3 and 4 here, just to summarize, we definitely would recommend Aots for those of you that are selling. We didn't talk a lot about the cash window. Majority of our clients do sell to the cash window. You're going to want to trade out as far as you can liquidly, and then recycle those trades to minimize that bid offer spread. And then look, the good news on volume is while the cash outs have capitulated, so that's been a change in the last 3 weeks. Purchase production remains strong. That's obviously the I think we'd all probably call that the $3 trillion question on where the market continues to go here for 2022. And again, we ran over time here. I apologize for that. I appreciate everybody's time, everybody for joining. We will, if the market continues to move, we will probably have a follow-up to this for the industry, and for those clients on the line. We will definitely be having another webinar here in the next month. But I appreciate everybody's time, and thank you for joining us.
Thanks, guys.